Okay, good morning, July 28th or July 21st, 2026. It's been a while since I've done a video, and just getting set up here and everything. Um, so I was out sick a little bit last few weeks, or last 2 weeks, I should say, or week and a half. I think I managed to get a video up and everything. Let me just check on my phone and see if this is do a sound check and everything here. Let's see, where are we here? Let me share the screen. Or no, I do see there's microphone is picking up, so it looks like we're okay. Let me just get the sound. Yeah, there we are. I think we got some better sound now. All right, so what do I want to talk about today is I want to analyze the bubble, the AI bubble, and I made a little bit of a presentation just to walk through. I'll just keep this to the side right now. Let's just go through the basics. Let's just see if anybody's in here. I don't see anybody in the chat. It's a bit early by the U.S. time, 7:30, but this is as late as I can go. I'm in Ukraine at the moment, and my kid gets done with daycare after this broadcast, and then it becomes impossible. But let's start out. So, what's in the last week? Excuse me. In the last week, we've seen a few new names get picked up by our. Excuse me. Oh, yeah, maybe I should take another day off. It's no fun having allergies. But let me get the screen shared here, entire screen. Yeah, so here we are. We can see where the conversation is. It's still NVIDIA. Today is Google earnings. GE Aerospace is starting to get into the conversation. We still have our TSM, SpaceX, Netflix, I think because of the earnings, and there's a lot of discussion, is Netflix still a viable company? I actually have a small position in Netflix, but I'm looking to get out of it after giving it some thought. I think I didn't research it enough. That was my bad. But and this is not financial advice, but unless they can come up with another Breaking Bad or I don't know, this show with the dragons or something like that. I think they're going to be having a lot of competitive pressure from all the other streaming services. They used to be the only one, and now everybody is streaming. You have Apple, you have Disney, you have all sort of people streaming right now. And Palantir is coming back as well, so into the conversation. We can go back 30 days and see what was going on here. And this is the Ticker Pulse app. You can go ahead and sign up, and there's a lot of free content to review. And if you really want to dive deep, you can write me, and I'll give you a pass. To explore the paid features. I'm pretty accessible. So in the last 30 days, you see a lot of SpaceX, a little bit of gold, coming up. This is what the bloggers are talking about. Micron was, all of the memory was really part of the conversation. But let's go through our macro indicators. So it looks like our 10-year has been climbing back up, and this is the Iran war. That's creating a lot of nerves in the market, as one would say. My view is it's going to be a long war, but it's going to maybe ebb and flow as far as the intensity goes. I mean, it looks like the U.S. will be there for a very long time, in that region. I don't see any breakthrough agreement where everything goes back to the way it was. There's some kind of new normal that will form. And I don't think it'll be forever, but it's going to be a long war because the Arabs are already building pipelines to go around the Strait of Hormuz, to bypass, so that the ships don't have to go all the way in to pick up their oil. But if the U.S. blockades Iran, then this Iranian energy won't be hitting the market. That will create some new demand, but that might create new production as well. It'll put a lot of pressure, on current producers to make more oil. And then eventually there could be an oversupply situation. That's what's happened in the past. We've never seen $200 oil. We've never seen sustained 100 plus oil. It always comes crashing down because there tends to be like an overproduction at some point. So this is 20% of the world's oil supply. Yeah, here's the oil prices. Let me just refresh the screen. It looks like it's popping off though, up 83 bucks. I think higher for longer here to stay. Yeah, oil is elevated, but usually when it gets up there, there's like this overproduction situation. A lot of oil that was too expensive to get out of the ground suddenly becomes viable. So you have to take that with a grain of salt. But um, yeah, it just it's really hard. I mean, no one can see the future, right? So the only thing you can do is build your portfolio around this so that you can still capture if there's some upside, but you're guarded against the downside as well. I mean, that's easier said than done, straddling the fence. And we're definitely in full fear mode. The greed index has come down, and it was right. This is not financial advice, but these are like, when everyone's in extreme greed, this is the time you're selling. And if you have the nerve, maybe this is the time to buy. Maybe not. Maybe it's going to go down more. We don't know um, uh, about this war, but as time goes on, there will be new sources of oil hitting the market. There will be conservation, just like in the '70s. Maybe Americans will start downsizing their cars. They won't be buying these gas guzzling Porsches. I don't know why I keep getting ads for this. I think because I saw Risky Business the other day and I Googled for the Porsche 928, what Tom Cruise was driving in that movie. I was just curious to see what they're running now. They're still quite expensive, more than their original price. They were $40,000 back in the '80s, and now there's 70,000 used for a good example of a 928. Um, yeah, so that was just curiosity. I have no interest in actually owning a car like that. Maybe rent it for a day or two and then give it back to the person for them to take care of it. But all of these indexes here are the greed and fear, except the volatility. It's popping off as a total fear. So is this the time to buy? And that's the big debate among all the bloggers. Are we starting a bear trend, long-term bear market, where just things keep selling off and going down until the PE ratios go down to something more normal, like 16 to 20? Or is this a buy the dip? Um, so a lot of this again depends on the Fed rate hikes. Uh, right now, it looks like July will be all clear for the Fed meeting. July 29th. Rate cuts. No one's expecting any cuts, but they are expecting like a 50-50 chance that there'll be a hike. So that's what's driving markets. I think we're going to have a lot of sideways action and everything. We just take a look here. So yeah, yeah, that's where we are. And then what I wanted to show you too is this one. This came up. I was watching some financial videos last night, and this is the Schiller PE ratio. So they show like a S&P uh, PE ratio. Let me just put that side by side. S&P 500 um, historical PE ratio. Let's see what we got here. So yeah, when you look at this, right? So this is another way to look at it. So the Schiller PE ratio for the earnings number, they take the average earnings over the past 10 years, you know, going back till 2016. So they even catch some of that COVID, time in there when stuff was basically turned off, and they kind of that normalizes the PE, as one would say. So it's showing here that it's very high when you do it that way. But when you do a PE, just PE ratio analysis of the S&P 500, um, let's see, it's quite low compared to these highs that we've had, like in the 2008 financial crisis, or even year 2000s, or so. We're not so bad. if you take a snapshot of it. But when you do it on average, it's getting alarming, and that's like a point of debate. But now let's get into the presentation about a possible bubble bursting here. So let's open this up. I'm not all entirely equipped for total video production. I'm just starting out, and you know, and, have to keep other things going in life. This is not a full-time job, but I'd like to share what I know and hopefully connect with some like-minded people. But what I want to do is compare 2000, 2008, and 2026. History doesn't repeat, but it often rhymes. So, yeah, I just want to share my views. The war in Iran will go on longer than we think. That'll be inflationary, at least in the near term, until they can reroute the oil supplies and find new sources, and maybe the U.S. population starts adjusting like they did in the 70s, going to smaller cars, carpooling, whatever. If the U.S. can cut their consumption by 20%, if every American could cut their oil consumption by 20%, then suddenly the world will be awash in oil, and then the inflation threat will be gone. That's why I'm saying the impact on oil prices will be less than we think, because I think they'll be there, but like I said, there'll be overproduction, maybe conservation. Um, the Fed this year will hike 25 basis points, to keep the it'll keep real inflation negative. Our real inflation rate, like I was saying in a previous video, is you take the Fed rate minus the rate of inflation. So we're at like 3.5%, and the annual inflation is like 3.8, 3.5. So you're still a little bit negative. If you take the last inflation print, which was 4.2, or the next one, if this oil spike and gas prices come through on the next print, we're about negative 0.5%, negative 0.75%. I would say more closer to negative 0.5%. So raising 0.25, we're still like running negative. Um, Negative. I should say real interest rates. Keeping real interest rates, not interest rates negative. Yeah, real. Yeah, the real interest rates will be negative. That means if you buy a savings instrument or any kind of bond instrument, you'll have less money when you go cash it in the future, even though it's showing 5%, or let's say in this case 3.5% or whatever. The inflation will eat it away. That's There's plenty of that. Those explanations. I mean, if you want a bigger explanation, you can, you know, tell me in the comments, and we can explain how that all works in detail. Um, so in this presentation, I'll talk about what caused the dot-com crash, the housing crash, where are we today, bull case for AI, bear case for AI, and I'll again talk about my investment strategy. So the bubbles, where did they come from? So in the 2000, it was tech stocks. This was really, I think, a true. I would say the dot com era was actually a revolution. Everything else, like now that we're seeing, is an evolution. Search and all of this, like the internet was like a new thing altogether. And then things were built on top of the internet, but there was nothing like the internet before. It's like the industrial revolution. First came the machines, and then everything was built, all kinds of different machines, and things were evolving. So this was the first real true revolution I think we've had in our lifetime, that we've seen. Maybe there was something with plastics or materials, carbon fiber. Those could be revolutions as well. They're just overshadowed by the information revolution. And it was all fueled by easy money. Everyone wanted to be a part of this. Everyone thought like pets.com or whatever. There's all kinds of excite at home, internet providers, people providing the service to the houses, Amazon, e-commerce, news sites, YouTube, and all this stuff came about much later. There wasn't much YouTubing going on. There was something called broadcast.com before the first crash. And then Google bought that, and that became YouTube later on. The very first thing to ever be broadcasted or streamed was, I think, the Victoria's Secret fashion show on broadcast.com. So that was how it was back then. There was still just everything was in the beginning, but the next 20 years was already priced in, and the markets wanted to take that back. So now we had a lot of warnings back then. Alan Greenspan saying irrational exuberance and all of this in the mid '90s, and if you would have sold out after Greenspan, giving that irrational exuberance speech, you would have missed out. So it's tough. I mean, the narrative broke. What happened is the IPOs started drying up, the venture capital started drying up, and if you were reading closely between the lines, you would have been able to pick this up. I mean, obviously, hindsight's 2020. We weren't as smart back then as we are now. We don't have the experience. We didn't have the experience of recent crashes in 2000 like we have now due to like over investing in technology. The other crashes, like I think '87 was not like this. That was something else. That was due to interest rates or the deficits or something. The '87 crash. But what happened is they say the narrative broke. It was just done. All this new IPO money and everything was done, and it was time to get out. In about March 2000, everything started to just melt down. There was a Barron's article had come out back then. I remember all this. I was around, and just everything started going to hell in a handbasket. Now, housing 2008 was real estate. I mean, stocks took a hit, but everybody was in houses. Houses were quite affordable after 2000. And a lot of the money from stocks ended up going into housing, and people got really good deals on houses. Took their .com money, or they just decided that they would, so they were burned on stocks, that they would just keep investing in properties. So now that was real estate, but the way it got out of hand is they started doing subprime mortgages. They were giving mortgages to like bartenders and strippers, and they were buying like four houses without any due diligence. The bank wasn't doing any due diligence. The bank was just taking them for their word that they could buy those houses, put renters in there, and get their make their payments. And we had actually, just like in the .com era, the Fed was hiking. The Fed was hiking rates. I mean, we were having hikes in before 2000 for 5 years before, where rates were successively going up. I mean, there was a big dip in '96 when the Chinese had a bust, and actually that brought more money back in the stocks because low interest rates drive stocks up, and then the rates started going back up again. So, housing 2008, the biggest danger to adjustable rate mortgages and housing is rate hikes. It keeps more buyers out of the market, and we had that going on from 2006. So 2006, we got the first warnings about that, and then there was a lot of talk about excessive credit. If you were watching all the credit indicators, you could see the credit markets were coming apart. And finally, the mortgage default. Some banks had blown up, and then that caused a whole bunch of other banks to blow up, and people thought they had AAA loans, like from a husband as a fireman and wife as a teacher, taking a mortgage. They thought they had those loans, but instead people had the stripper married to a bartender loan, and those were blowing up, but they were rated AAA, and they shouldn't have been because no due diligence was done on them. I mean, those they can make a lot of money, but a lot of times they don't pay taxes, and they get an IRS bill. Then guess who doesn't get paid? The mortgage company, right? So that's what happened in 2008. The AI infrastructure is where we are now. They're building massive amounts of data centers. People are just buying these NVIDIA GPUs for $250,000 a piece, by the truckload. They can't make them fast enough. And people are wondering, like, what's going on? And I should say, is the bubble now? Are we in 1996? Or are we in 1999? Or, where are we? So I would say we're somewhere between 2026. I would say, I'd say, I mean, this is just my view. I think we have a little bit of time, maybe 6 to 12 months before this all comes down. But we don't know. The Iranian war could bring this down quicker. But there's a lot of concentration on infrastructure. The most of the S&P 500 gains have been just from a few companies involved in a data center. And I think today the Google will give us also an outlook on on the capex spending, but it looks like the capex is going to go on and on and on. I mean, you had Larry Fink the other day from BlackRock saying that. I don't know if I can move this box around. I guess not. Yeah, there we are. Saying that it's quite encouraging. So I don't know if I can reposition this or not. I guess not. All right, so let's go to the next one. So the dot com bubble. What we were talking about is the causes. The Fed had been progressively tightening, and taking money out of the market. The PE ratios back in the dot com era were insane. A lot of companies didn't even have earnings, and the venture capital started drying up. Looking back, hindsight's 2020. There have been ways to find out this information to see who was getting deals and track the deal flow of who was getting funded. It was like insane in the early or mid 90s, and then it started slowing down actually even in 98. Insider selling was also like a canary in the coal mine. That they indicate that's all indicated on Yahoo Finance, which was the portal of the time back then. It's still pretty good. So that's something you want to keep an eye on. And there's a fair amount of insider selling now going on. Um, but what was very different then is a lot, like I said, a lot of these companies didn't even have any profits at all. And going on now in this AI bubble that we're in, or air pocket, I don't know what you want to call it. Um, the earnings are really good. Yeah, they're from really solid companies. Google, Microsoft, Meta. These companies are no joke. I mean, they're really well-run organizations, and they're printing money mainly through their advertising. I mean, instead of people buying billboards and placing ads in magazines, all that money just came to a few companies. Microsoft is selling its Office licenses. They don't really do much for advertising. Maybe on LinkedIn a little bit. They're trying to boost that business, but that's nothing compared to their other business. But it's Meta, Google, and have got a massive advertising business, and Amazon is starting to pick it up, and even Netflix is picking up advertising. So all that advertising money has come to a few people. It used to go all over. It used to go into many different periodicals. It used to go, like I said, on billboards, on the walls of bathrooms and restaurants or whatever, wherever people could get your attention and hold your attention. And now it's all coming to the internet, right? So, the dot com gave us the breakthrough technology, e-commerce, instant news, social media, chat rooms, all that kind of stuff. But they were terrible investments because everything was coming in the future. They had to put a lot of upfront money, venture money, and then that all burned out, mismanaged. Too many corporate parties or whatever, trips to Monaco for shows. Um, a few companies survived, and they're still around today, and they're behemoths today. Amazon, Microsoft. It was like a winner take all. Cisco survived, but it took them 20 plus years to recover. Google wasn't really around in the first bust. I mean, they were just really little. I don't even think they were public, and Facebook wasn't at all around. That came much later. So just because something busts doesn't mean the technology breakthroughs stop or the evolution stops. Like Dan Ives keeps saying, we're in the third inning of a AI revolution. So it can crash, and the game still goes on. The baseball game will still go on even if everyone in the audience loses all their money. The other things will come about, and that's what we saw. Google and Facebook came post crash. They came into their being. No one even heard of Google. It was all Hotmail, for your email. Now everyone's using Gmail, but back then it was Hotmail, AOL. Lycos was the search engine. People would use Yahoo, would search a lot on Yahoo, was like a big search engine. I mean, Yahoo has gone private now. They don't even exist as a as a tradable stock. Now, the housing bubble, we can talk about that. Yeah, that's the subprime loans. So there's houses everywhere for sale, and people want to get the houses sold, and the banks were unregulated on this. I think they've passed more regulations, and they were giving loans without doing any due diligence, checking your salary, checking your credit, or having you pay a higher interest rate, doing these adjustable mortgages where you pay 1 or 2% for the first 2 or 3 years, and then it goes back up. Um, They're all kind of crazy loans you could get without much checking. And adjustable rates are really bad because people are already on a tight budget. They're paying like $500 a month, and suddenly that loan jumps up to like 900. Uh, and they have a car payment, they have a student loan payment. They're eating out all the time. I don't know, having a lot of bills, and it just blew up their budgets. And all these adjustable rate mortgages reset around the same time, and that caused a lot of issues. The rating agencies were, rating all these bad loans or subprime loans as AAA, and that because they would bundle these up into financial instruments and sell them off to. There's like a video about a village in Norway buying what they thought were AAA American loans, like a husband and wife, doctor and nurse type couple or something, with really good financials. Their mortgage was in the same basket as like guy who just got out of jail and working at the 7-Eleven and somehow lives in $1 million mansion, having it all rented out to roommates. And people were getting all these house flipping loans, and then they couldn't sell their flipped houses, and those were rated AAA as well. And so a lot of pensions and everything blew up, and the Fed was hiking. The Fed was warning about this, and then the inventory suddenly exploded, and all the prices came crashing down. And this was just too much financialization of the housing market. Housing's supposed to be owning your own house is supposed to be a privilege, not a right. You're outside of the VA loans. I think everyone else, like I think veterans should get the 0%, or teachers and firemen should get 0% down. But everyone else should put 20% down. That's like a reward for saving. Then you get a conventional loan, and putting that 20% down gets you already in the discipline of in a mature discipline to do that. I don't know. Yeah. See, I can't show my logo here, because my head is blocking everything. But one day we'll get there, right? When I have more than 0 viewers, So I don't think we have anyone in here. I don't know. Give me a sign of life if anyone is watching this. Say something in the comments. Like and subscribe this video. Um, so that was and this is a lot different than AI, right? So AI, all the spending is being done by responsible companies. I mean, like the bull case is like there is real productivity being gained from this. I've seen it in my personal life. I mean, when I do meetings at work, I can use an AI recorder, and it does all the meeting notes, and it helps me write the emails faster. And this drudgery, this boring work that used to take like 1.5, 2 hours a day of doing now is like down to 15, 20 minutes. I can get through things and work on the important problems faster. So I see it in my everyday life. Now, is it worth trillions of dollars? That's the question. It's like the internet. The internet was a real game changer. Being able to send emails and send files, through the internet, versus using the snail mail back then. That evolved into doing stuff over your phone. Using SMS messages to pay for parking. But was it worth all that money? In the long run, yes. In the short run, no. So it's all about timing. Now, earnings are really strong right now with these companies. We're going to see Google today. I think will do really strong earnings. Amazon is always posting good. Um, JP Morgan, posted really strong earnings. BlackRock did. And they said this was all because they didn't have to hire extra people to get the extra work done. AI was able to fill the gap. They were able to make their current workers more productive. We're seeing medical work, drug discovery done at Johnson and Johnson, Eli Lilly. They're using AI to iterate through all the different combinations faster and to do the research quicker. Uh, Caterpillar and Siemens have improved their supply chain with AI. So it's not everybody is losing on AI, but a lot of people are. Um, and a lot of that can be attributed to that they don't know how to do it. Like a small and mid cap company may not have the tech people who can implement it properly. There's some arguments about that, like they haven't been really told right, but you're seeing studies like 85% of people haven't gotten anything out of it. But your really big companies are getting something out of AI, and it's showing up on the earnings. So, like I said, the valuations are lower now. That's like one of the bull case. I mean, we can even look at this PE adjusted case Schiller. So let's see, like in the 2000, right? So this is the dot com bubble. It was much higher than it is now, even with this K Schiller PE, what they call the CAPE or something like this, K Schiller PE ratio, um, or a case, yeah, K Schiller adjusted PE ratio. It's called the CAPE. But we're getting there. We are getting to a point where if you do this adjusted PE, but this is a little bit skewed because it probably has some of the COVID data points, that have pulled, the earnings number down, which makes the price, the numerator go up. So we might even be down here, and a lot of these gains have been just the compounding benefit of technology. So the earnings have been really strong. So maybe the earnings will pull this number down versus the prices have already come down a lot. I can say that there's been some preemptive action. Like I said, everybody has now got a place to look at in the past. Everyone's got 2000, 2008, and people are already being proactive and rotating. I did it. I did it beginning of the year. I sold off a big chunk of Nvidia and started diversifying my portfolio, but we'll talk about that later. Um, so yeah, where are we here? Yeah, the AI bubble. But yeah, the bear case is like this spending, on the capex. It's like they're comparing it to the railroad. When there was a railroad boom, they were just putting rail lines everywhere without giving it much thought. And people now are building data centers left and right and wondering if they have capacity or not. But you're hearing different stories. Like Elon Musk rented his data center um, to I forgot this Anthropic, and they're talking about this Chinese DeepSeek thing, this new one that they have, this new LLM that it's apparently already they can't take any more customers because they need more data center capacity. But then you're hearing about these projects they can't get going because they can't get permitted for uh, energy. So there's like a lot of mixed news on this. It's controversial. You can read things both ways, but the electricity shortages, I think, are the real bottleneck here because that's hard. That's not something you build overnight. And the gas turbines at GE Verona are sold out till like for the next 4 years. I think Bloom Energy is doing a lot of business, also selling gas generators. And nuclear power takes like 10 years to get up and running. Again, the market concentration, it's a very crowded trade. And there were some charts here also showing a market concentration of past bubbles. Let me take a look at this. Market concentration of AI versus past bubbles. Now we're getting close, like 40% of the market is in like just a few stocks. There's like some chart here about this market concentration. Yeah, here we go. This was the one. This is what I had seen before. Yeah. So, yeah. So in 1988, it got into 44%. I think this was the Japanese bubble in the 80s, and then 2000 was yeah. This is the dot com, but this was the railroads had gotten all the way to 63%. So we are like in a. It's hard to say because one could argue that this is also just building on top of current cloud services, or is it exclusively for AI? But it's definitely a warning, right? That we got the market concentration, and the ROI picture overall is unclear still. When do we get all this money back that we spent? We're buying all these GPUs. When do we get the money back before they go out of date and we have to replace them? Or they can make those GPUs run longer until the money comes back. So it's a bit foggy. And it's like that with any new technology that you hadn't seen before. No one could have ever guessed the railroads. If you were just looking at the railroads, like charging fares for the train to take freight and people, um, you could never really figure out when you were going to get the money back for all that iron that was laid. But no one could ever guess all the towns that came along the railroad, that emerged along the railroad. They're all kind of cities and towns, all kind of businesses that were grown up around it. And so the market, after the crash, that's when the money will be made, picking up the pieces, as one would say. So you have to be hedged for that. Um, yes, AI successes. I think we already talked about this. I've already jumped ahead on this one that J.P. Morgan and BlackRock say they had successful implications. A lot of law firms are saying it's really helped them a lot for faster research, better case preparation, uh, healthcare, drug discovery, and supply chain in the industrial sectors. But we have power shortages, transformer shortages. There's delayed building and data centers are dealing with bureaucracies. People are concerned about capex overspend and the circular capital flows. This is what Michael Burry is all up in arms about. And then a lot of debt financing. Now about the debt, like I said, AI debt is nothing like subprime. This is companies like Google and Amazon that already have really good cash flow from businesses that were around before AI, and they can pay back those bonds. And if those bonds do bust, there's been some Goldman Sachs things talking about carnage and everything. And Felix and Friends, he had done some YouTubes on it. But my view is that it'll just get bailed out. Somebody will buy that debt. It's pretty high quality to borrow your money to Microsoft, Google, Meta. You're going to get paid back. It's probably a better risk than even the U.S. government, in my view. So I don't take that one too seriously. These companies have a lot of cash on their balance sheets. They could just pay it back just from their cash piles. Like Microsoft has a tremendous cash pile. I think more than some countries are worth. They all do. Facebook, Google, Amazon. They're all building up these big piles of cash. So yeah, we talk about concentration risk, too much magnificent, too much investment, in Magnificent Seven. All the people are putting their money on just a few stocks. They're not spreading it out enough, but that has happened. That's actually in recent weeks. There's been a proactive rotation. No one's waiting for the crash. People are trying to get ahead of the crash now. That's something we haven't seen before. Everyone's talking about it. It's a mainstream topic. It's not being dismissed. People are caveating it and trying to compare it. The fact that we're having this conversation, we might avoid a crash altogether and just get like some big rotation or some correction or a series of corrections that are be easier to digest. Um, the only thing that could really, really derail and crash the market is if they do like a 50 basis point Fed hike, something we aren't expecting. Uh, or if there's like suddenly Google tells today that they're not going to be spending any more on capex, that could do a big crash. But a lot of us are already prepared for it. People have already been rotating, and Nvidia's PE ratio is lower now than it was before the AI boom. That's also interesting. So yeah, these are all the possible triggers that we're seeing. The electricity bottlenecks, I wouldn't say would be an overnight crash, but as it piles up that more and more data centers can't get electricity, that'll be like a death by a thousand cuts. So let's see, we're at 38 minutes. Yeah, let's wrap this up. So yeah, bubbles don't pop because something is expensive. They pop when the narrative breaks, when people stop believing in the idea. Um, I think what these companies need to do is start showing more AI success stories, and really show that the money is, there's ROI on this, not just job cuts, but actually expanding the business versus just cutting people, because that's actually wrong too. The people are supposed to be repositioned. It's not artificial intelligence; it's augmented intelligence. Um, so let's just do a summary here. So the profits, the AI .com didn't have very good profits. AI era, the companies are really profitable. The revenue in the .com era was quite weak. Things were just starting out. Um, Margins were very thin. But in AI, the revenues are quite strong with these AI companies. And the customers, .com was like doing eyeballs and all this. AI, you have real customers. You have real companies buying this stuff. You have people buying GPT subscriptions. The PE ratio was definitely much higher. And this is just a snapshot PE, not the case PE. Um, it was like double back in the .com era than what it is today. And I'm more for the snapshot PE in the sense, like I said, the KPE is taking into account some of this COVID numbers and pre-AI numbers. There's a lot of big changes since COVID, and a lot of advancements. um, and we're not going back, right? Microchips have gotten better, materials have gotten better, logistics and software, everything got a lot better after the 2020, and so I think that last 4 years is really pulling down the earnings, component of the PE in this CAPE projection. Cash flow, like I said, is very strong. Cash reserves are very strong now compared to before. But it's the same thing. They need a lot of Cisco routers and hubs and switches and cabling back then, and now it's the GPUs, CPUs, and all these buildings. So that's the same. This infrastructure, it is healthier, but I would be concerned because the numbers are much bigger, and definitely what's different now than then is the federal budget deficit. Right? It's let's take a look at that. That's huge. Um, and that becomes like a big problem. So let's federal deficit. Both the running current deficit and the national deficit um, is a problem. Let me just see if they have a chart. Okay, that's just a Investopedia federal deficit chart. Okay, this is okay showing the budget deficit, federal surplus or deficit. So yeah, we're running massive deficits, especially compared, like even in 2000, we had Bill Clinton as president. He managed to get us a surplus for a short time, but then we have that recession, and everything just went to hell in a handbasket. Now we're just running massive deficits. They're trying to come back up, but now we have this war. But let's see, national debt. Let's see, national. Yeah, here we go. Total federal debt. So yeah, this is something. That's going to affect the treasury market, the bond market. The bond market doesn't always act on the Fed. The Fed rate is 3.5%, and this is at 4.5 and almost 4.6 and climbing, and 4.75, 5% becomes like a bit of an alarm. Then a lot of money will get sucked out of the markets altogether and reallocated to bonds. Um, see another. So yeah, the oil prices are climbing. I hope they get that solved. Um, So that's one of the big uncertainties we're dealing with. Also, that can all pop the bubble. Is this we didn't have wars back then. We had Iraq, in 2008, Afghanistan, but nothing like what we have now. That's going to have such a huge impact on the global economy. So AI is not another dot-com bubble. It's something we're going to probably see something we haven't seen before. There's something wrong, but it may not manifest itself quite the way you think. AI is creating real value. The bonds are backed by AAA companies, but the infrastructure spending is, I think, in a bubble from what I'm reading. It's maybe going too fast, um, and there's maybe hitting bottlenecks. Like they can build a data center and then they can't power it up or get the water for it. There'll be things like that happening. Where they could just sit empty like those ghost houses in China. And again, we probably won't be seeing that for another year, year and a half. Um, so that's what you got to do. You got to reduce speculation, own profitable companies, and keep dry powder. There's nothing wrong with holding cash. And as I said in previous videos, and we can see the Bitcoin price is starting to edge up. I've got a small. I don't ever keep more than 2% in Bitcoin. Bitcoin price USD. But we can see it's been coming up since we've been last talking. It went down and then went up, but it was like in the last 6 months it came way down. But we're here now, down here in this. And if you look at the 5 year, it was way up there, and that's kind of how it does. It shoots up and then it stays down, and then it shoots up and then goes way down. Um, so I'm adding a little bit, not much. Gold is actually out of favor now, but gold won't come into being until we get some rate cuts. Let's take a look at the 5 years. So yeah, gold has really peaked, but it's got a secular upward trend. Um, I'm getting a little bit of the gold mining companies here. I added Johnson and Johnson, J&J. This is a good one. They're aiming for 100 billion in revenue. There's a whole bunch of YouTubes about them basically tripling or quadrupling their revenue from where they are now to they got some breakthrough drugs coming. They've been a little bit down and out of favor. Last month they hit a peak here and they started coming down a bit. Just to diversify. America and business is still working. If the stock market goes down, doesn't mean all the companies shut down. So there's a lot of good companies that are still working. But what I gotten out of, I used to have Hut 8, which is like a neo cloud. I sold that off a while ago at 125 bucks. I bought it at $8. Um, and now it's at 100. So it went up and then came down. It looks like it's going up, but I'm avoiding companies like this that don't have earnings. I'm avoiding things like this right now and just going to quality. I still have Nvidia and VDA stock. I have to get a graphic of the portfolio again. Um, so that's hovering along. Out of all the semiconductor companies and all the AI companies, this is the highest quality. The forward PE is only 20. Right now, the current PE is 31.3. But if you take the earnings that they project for the next period, it'll bring it down to 20 at this current price. It's pulled back from its highs. Um, I wouldn't buy any more of this, but if you got it, maybe sell covered calls. Sell covered calls way out of the money and just get some premium out of it. I think this is just going to move sideways for a while, but I don't think it can go too much more down than where it is now, unless there's an accounting scandal, the circular flows. But those circular flows I was reading is actually quite common in like Japan and Korea. The big companies give money to little companies, and little companies buy stuff back from the big companies. Um, so I don't know. I'm not too worried about it, like I said, because these are all established companies. Like Nvidia put some more money into Nebius, and Nebius obviously will buy more GPUs. But are they? They wouldn't be buying these GPUs unless they needed them. They could just take that money and go throw a nice company party, right? So that's where I'm a little bit of a bubble skeptic, but I think there's something going on. I think I think we're around 6 to 12 months before something really major shakes. Right now, we've maybe seen a pullback, but who knows? Maybe this proactive pullbacks will, stop us from peaking. Let's see what else. Oh, GE. GE jet engines. Yeah, GE Aerospace. That one I bought. Yeah, I started picking up this stocks. It's off its highs. So I started picking this up as well. They got some big orders, and this is better than Boeing. Better way to play aerospace than Boeing because Boeing has still got a lot of baggage to deal with. These guys just make the engines for the planes. They don't have to deal with all the other stuff. But they got an order for 1,000 engines somewhere. Um, let's see. Yeah, yeah. So they were getting some good orders and everything, but they're just not loved. But that's your opportunity. This is not financial advice. And then GE Verona, they make the generators. And it's not just for nuke plants. I mean, they do build small nuclear power plants, but they also make like gas engines. Power, even without AI, is a problem in America and a lot of the Western world. And this is the go-to company for power generation. I felt like they were off their highs. It's still a little bit of a richly priced stock, but it looks like it is slightly off its highs. Now, I got this a couple days ago, so yeah, it looks like in the pre-market is already up. I got it closer to like when it was 1,000. It had fallen off down here, and I'd been watching this for a while. Been a bit of a skeptic because it's a capital-intensive business and has a PE ratio like that of Nvidia's, but they're dealing with a lot more overheads. But it's also harder to replicate. So yeah, that's where I'm at. I'm just spreading out. And of course, I'm keeping a ton of cash, and then Berkshire Hathaway is 20% of my portfolio right now. Uh, Warren Buffett seems to, his company seems to do well during a crisis. They have all that cash; they can pick up a lot of stuff at really low prices. Private companies, public companies, overseas companies. Um, so it hasn't done anything, but this is kind of like a insurance. So if there's a hit on the market, they're going to be sure to do something with that $400 billion that other people can't do. Oh, thanks. Thanks for telling me there. I didn't look over here. Yeah, thank you. Uh, how do we get more people in here? Um, yeah, I have to recover a bit more. I mean, Jesus, last flu from a kid, man. This just it's almost killed me here. So yeah, reduce the speculation. Um, stay with the quality companies now that are at a fair value. Don't just a quality company becomes a bad stock if it's overpriced. So just always watch those ratios and everything, and you're not missing anything if you don't have a stock. It doesn't change your life. Just wait for it to come to you sometimes. In this era where they're talking about higher rates and we're at war, it's likely to happen. Now, if there was no Iran war and oil prices were $40 a barrel, and inflation was under control and unemployment was really low, um, you know that that's a different story. Then you might want to get in and ride that wave. But right now, it's we're kind of going into cautionary times. But anyway, okay, that's all I got. This was a long stream, so take care. Bye bye.